Hey, Home Buyers Realty Group. This is Josh Holman at Summit Funding. It is May 3rd, 2022. I wanted to do this video to go over a few basic things about FHA loans to help you guys sound a little more knowledgeable and help you out with some basic buyer questions that you might get regarding FHA loans. Well, first off, FHA stands for the Federal Housing Administration. So it is a government loan. We tend to use FHA when we have, I would say, average to poor credit scores. So the lowest mid credit score is 580. And then typically anything from 580 to, in today's market, about a 700, maybe high sixes. If they're putting a minimum down payment, we typically tend to quote FHA loans and FHA rates because you get better pricing. Interest rates are a little more favorable if you have, average credit to low credit, and the mortgage insurance is typically cheaper than if you were to quote someone a conventional loan. So 580 essentially is the minimum score that you need to be able to even qualify for an FHA loan and get financing with an FHA loan. And then just for what we end up quoting for the buyer's benefit, typically anywhere in like the high sixes, even sometimes low sevens, depending on how pricing works out, we'll go with an FHA quote. A few things you might get asked could be in regards to bankruptcies and foreclosures. So for I can even show you a credit seasoning screen here. Pull this up. For Chapter 7 bankruptcies, you need at least 2 years of seasoning from that discharge date for a Chapter 7 bankruptcy. So 2 years after the bankruptcy has been discharged, that is what you would need for an FHA loan. And let me see if I can share my screen here on the recording. Looks like I can. So here are some timeframes, credit seasoning timeframes, and we can show it here live and direct. Make this a little bit bigger. FHA, Chapter 7 bankruptcy, 2 years from discharge date. A Chapter 13 bankruptcy, 12 months from the discharge or dismissal date. Typically, this rarely happens, but if someone's in an active bankruptcy, you would have to show 12 months payments and a court approval for a new mortgage, but typically that doesn't happen. Foreclosures, 3 years from the sale of the foreclosure. A charged off mortgage follows the same time frame, and same as a short sale or deed in lieu of foreclosure, it's 3 years from that sale. So I know that's probably a typical question that you guys get asked if someone maybe has had a foreclosure or a bankruptcy. Those are some seasoning timeframes for you. Let's see. One of the next reasons why we would use an FHA loan when it comes to income and debt ratio. So debt ratio for an FHA loan is more forgiving than a conventional loan. So if we have a buyer that's trying to really max out their purchase price range, debt ratio is something that FHA is a little more lenient on. We can typically go up to 56% on the back end. Now that's absolutely maxing out that debt to income ratio, but 56% is pretty much the max. Anything over that is going to get an automatic ineligible status when running it through the automated system. We want to look at a 2-year work history. In most cases for FHA, they are, 24-month average is what they start to look at unless you are a salaried employee. If you're self-employed and you're doing an FHA loan, they automatically want, 2 years worth of tax returns to calculate that self-employed income. Whereas a conventional loan, sometimes you can get away with just 1 year if they have good credit or if they've been in business for a long time, depending on what the automated system shows. But FHA, self-employed, 2 years tax returns, no exceptions. Work history as well. We want to see that 2-year work history. If it's someone that is counting on maybe overtime income, bonus income, commission income, they want to see a 2-year work history of that, a 2-year receipt history of that type of income. A common thing that I see with appraisals that you should definitely take heed to when you are, showing a buyer that's FHA approved and when you're looking at the home. So some common items that generally come back on appraisals that aren't checked off that an FHA appraiser is going to call out can be the smoke detector and carbon monoxide detectors. Those need to be installed. Smoke detectors in every room, carbon monoxide detector in the house, water heater double strapped. A lot of times we will get these appraisals back and it's, you would think listing agents most of the time would have those things installed or make sure that they were there just so that there wasn't any delays with closing of the loan. But those are common things that we tend to get subject to items on our appraisals as if the house doesn't have those items listed there. Obviously no safety hazards. An appraiser is going to call out anything that's a safety hazard. Everything has to be functional in the house. There can't be a stove that isn't working or a stove that's not there. Bathrooms, everything has to be functional. It basically has to be a livable home, right? Conventional is a little more lenient on some of those things, a little more as is. Another common item that's called out on FHA appraisals is any exposed wood, anything that doesn't have any paint, eaves. A lot of times like a garage that might be a detached garage that has some chipped paint or peeling paint. A lot of times that gets called out pretty much on every FHA appraisal we'll see. So those are some common items that we tend to get back on appraisals for FHA that are called out and need to get fixed before we can close on an FHA loan. Minimum down payment for an FHA loan is 3.5% of that purchase price. That's for a standard FHA loan. Obviously, there's down payment assistance programs and things like that, but we will discuss that on a different video. But minimum down payment is 3.5% for an FHA loan. One thing that you might get commonly asked is in regards to FHA mortgage insurance. So if you're putting less than 10% down, FHA mortgage insurance is for the life of the loan. Most people, when they want to get rid of their FHA mortgage insurance, we will typically just look to refinance them once they've built up some equity and maybe their credit's gotten a little better and we can refinance them into a conventional loan. If they're putting more than 10% down on an FHA loan, then there's 11 years for that mortgage insurance. Again, most people won't be in that house or in that loan, I'd say, for 11 years. We'd most likely refinance them out of it before then. But if they were to stay in their FHA loan for at least 11 years and they had put 10% down originally, it would fall off after 11 years, especially if it was a FHA loan that was taken out after June of 2013. So that's probably a common question you might get regarding FHA mortgage insurance. Let's see. Loan limits. So FHA has different loan limits per county. Okay, it's a lot different than conventional. Conventional has a nationwide loan limit. And then for the counties that are a little more expensive, like the Bay Area, they have high balance loan limits that can still be considered a conventional loan. But FHA, it varies from county to county. So for example, this is something you want to be very careful with when you have an FHA borrower, FHA buyer, an approval letter. You want to make sure that if, for example, for San Joaquin County, the current 2022 FHA loan limit is $563,500. That's the loan limit. Again, not their purchase price limit, the loan limit after their 3.5% down. So if you have a borrower that's approved for that amount and they decide they want to go shop, maybe they were looking in Tracy and now they want to look in Modesto, well, then you have to remember, oh, shoot, that's Stanislaus County. The Stanislaus County loan limit for FHA is only for 2022, $460,000. So we've got San Joaquin County, $563,500 for this year. Stanislaus County is $460,000, and the Bay Area, Alameda, Contra Costa, is $970,800. So just again, when you're out shopping with your buyers, if they do start to relocate and look at different counties, just make sure and run that by the loan officer you're working with to make sure that they still qualify for that particular purchase price, because that could be a common thing that gets caught maybe too late, or when they're excited about a house and realize that they cannot qualify for that particular purchase price. Let's see. So in recap, minimum credit score, 580. And typically we put borrowers in an FHA loan if they're anywhere within the 580 to, I would even say 700 range. Anything over 700, we generally try to push to a conventional loan. Chapter 7 bankruptcy, 2 years from discharge date. Chapter 13 bankruptcy, 12 months from the dismissal or discharge date. 3 years if seasoning, if there's been a foreclosure. Again, 2-year work history, job history, tax returns, 2 years worth if you're self-employed. Again, we use FHA because it is a little more lenient on the qualifications. If you have lower credit, you can typically push your debt ratio a little bit higher than a conventional loan, go up to 56% is the max. Common appraisal subject to items that we see. Smoke detectors, see carbon monoxide detectors, water heater being double strapped, needs to be double strapped. No obvious safety hazards, everything functioning in the house. Exposed wood on the exterior, anything like that needs to get fixed and painted. Minimum down payment 3.5%. Different loan limits throughout the counties. Again, 563, 500 for San Joaquin, 460,000 for Stanislaus County. And anything in the Bay Area is 970,800. I hope this was helpful, some basic information from you guys to be able to answer some questions that buyers might have. Anything else, obviously redirect it to your lender, and we could take it from there. All right, have a good one. Bye.